All right, Yield Nerds, episode 149, and this time I am going to depart well away from the yield nerd and go to yield. Instead of the Y, put a T and tell me a word that rhymes with nerd. And I will leave the rest up to your imagination. I am going to play the frothy markets. I came out ahead. I'm going to share the formula I used, but that is not the way of the yield nerd for the first 148 episodes. But rest assured, I thought I would share my lessons. Well, we are up to 439 subscribers. I never thought I would see numbers like that. Thank you for your support. If you're new to the show, please remember there are two playlists that you may want to look into. The Income Investing Roadmap organizes this show in chronological order, and the Preferred Stock playlist is only about the topic of preferred stocks. Hey, most importantly, as much as I might talk about these amazing things I allegedly accomplished, please remember I have no magical powers. I've made plenty of mistakes and I'm sure I will make more. Make sure that you do your own due diligence. Well, let's look at the way I organized today's discussion. The first is we'll look at the market temperature, how the market is doing, how my portfolio is doing compared to the market. And I wanted to really share the lessons I learned about the world of index rebalancing. It happens 4 times a year, and I started educating myself on index rebalancing. That is when I came away with some lessons on, gee, I wonder if I can just use volatility to my benefit. I'll tell you what I did. I did double the portion of the capital that I allocated to that strategy. I'm too scared to think it is somehow something I can repeat at larger scale, but I would love your comments on what I did and what I learned. Finally, I'll share with you my holdings and my next steps. Before I proceed further, I want to once again reiterate, I am not a wealth management advisor. This is not investment advice or tax advice. I don't have product or politics as an agenda, and I don't have cats and hats and good merch to sell. So this is purely education. All right. Well, I am learning from my own mistakes. You can see that my portfolio took a nosedive when the market did as well. However, I've nicely recovered. This is a couple of days ago, December 18th, and we are at December 20th, and I picked right up back to where I was. And so things are going well. I beat the NASDAQ, I beat every one of the indices in my equity allocation, which is a small portion of my portfolio, but I sleep very well at night. I'm closing in on 5.84% on a total return equity plus fixed income. And so that is my portfolio. I'm not a day trader, except in this one episode, mind you. So speaking of which, let me tell you how I got to this whole volatility tirade. I saw a lot of articles around, hey, these three stocks are now entering the NASDAQ 100 and these three are being thrown out and index rebalancing is happening. So I thought, hey, how does that work? And let me understand what makes a particular stock qualified to be part of the index. So here is the index criteria, and the links where you can read all of these are in the episode summary. Feel free to consult them. So in order to be in the S&P 500, you have to be a US-based company, my kind of cup of tea. You have to have a minimum market cap, and you have to be in a public exchange, and you can't have 2% of your float on the public market. A good chunk of it should be there. And the last one is the very interesting thing. You need to have positive earnings in the most recent quarter and in aggregate over the last 12 months, which means the more positive your earnings are, the faster your revenue grows, the greater your odds are to belong to the S&P 500. And I said, oh, that's interesting. Let me look at the NASDAQ. The NASDAQ has even looser criteria. The NASDAQ says, hey, in order to be part of the NASDAQ 100, you need to be a public company for at least 3 months. That means somebody could literally show up and dive right into the NASDAQ 100. You need to have very high volume, and you need to submit reports. And I thought, wait a second, it can't be that easy. And so I started analyzing every one of the companies in NASDAQ 100 to understand what is their market cap, what is their revenue, what is their profit, how did some of the new entrants come in, and that is what I wanted to share. So what is index rebalancing? Well, the NASDAQ 100 generally only has 100 shares or 100 stocks. So on a quarterly basis, 4 times a year, the NASDAQ's board goes in and says, well, these three companies need to be thrown out and these three companies need to be brought in. Now, how do they decide? And you can see that Palantir, MicroStrategy, and Axon have been inducted into the NASDAQ 100. Now, what does that mean? Any index, any retirement account where you pick one of the indices or one of the funds that track the index is now going to buy those stocks. The higher the market cap of the company, the greater the allocation of that index to that particular share, which means Facebook and Apple and companies that are these mega stocks naturally have a greater weighting on the NASDAQ 100, so more of their shares will get bought, but the new entrants will now suddenly see increased demand, same supply, which economics will tell you means their price should go up. So I thought, interesting. So all I need to do is find companies whose revenues are approaching 8 billion, because 8 billion is the cutoff for the S&P 500, or companies who have been on the market for almost 3 months or just over 3 months who are starting to make a profit. And I can then predict, so to speak, which companies will become part of the NASDAQ 100 during the next rebalance at the end of March. And I can hop on that train earlier. And I thought, hey, flawless. How bad can that be? So I apologize for the crassness in the title. I descended from being an yield nerd to a yield T, and you can pick the word that rhymes with nerd but starts with a T. And so I thought, gee, I wonder if I can use market volatility, because all of these indices are tracking those companies whose share price rises the fastest, whose revenue rises the fastest, who are making a profit or are on the path to making a profit, and have been around for more than 3 months or more than 12 years as a publicly traded company. And I only allocated 0.2% of my portfolio to this crazy strategy because I'm not a risk taker. So you do you. I will say this last week worked out marvelously. That 0.2% doubled. That doesn't mean I'll be able to repeat it, but let me tell you how I went about it. This is showing Schwab. You would go to research US markets, and that will then bring up a screen where if you scroll down far enough, it will say, let me tell you what was moving and shaking today. And this is December 18th, and it'll be different for every day. And this one single screen has a lot of information. It says, I'm going to show you the companies that had the most volume across all sectors, across all exchanges, meaning NYSE, Amex, NASDAQ, and so on. And I'm also going to show you the 52-week range of that equity. So is it near the peak, or is it near the trough, or is it somewhere in between? And you can see how much it is moving today. I don't know the first thing about BioPath Holdings, aside from the fact that even though it literally doubled on that day, it still is at the bottom of the barrel of where it has been. That means it has a very long way to go to even catch its 52-week high. I'm just using that as an example. So one way to say it, if this were the middle of the quarter or 2/3 of the way into the quarter, the odds of BioPath Holdings making it to the NASDAQ 100 or the S&P 500 are near zero. I don't even need to learn anything more about the company, period, end of story. If NVIDIA was not part of the index, and you know, and I know it is, its odds of being part of the index in the next rebalancing are very high because it's already trading at a pretty good high and it is going up at a pretty good clip. Here are some that have huge volatility. If a 30% reduction still puts it at 2/3 of the way, that means yesterday it was over there. So this is kind of pushing the boundaries of the upper edge, as are quantum computing, D-Wave Quantum. Now, are these companies worth their price? I have no idea. All I'm doing is trying to see what qualifies a company to be part of the index, how does it move as the quarter progresses, and can I think the way the board of the NASDAQ thinks? That's all I'm trying to do. So then I started looking at sector by sector. I would then Find the companies that are already part of the index, see where they are. Find the companies that are not part of the index, see where they are. Understand which companies are getting thrown out and how they behave. And I don't want to go through this in laborious detail, but I went through it sector by sector, energy and materials and industrials. And Archer Aviation, for example, is showing the same behavior, whether it's revenue and its prospects support, a viable company or not, I'll leave it up to you. American Airlines is roaring at the top of its share price. Whether that is justified or not, you do the math. So you can literally go through each of these sectors and you can see that the index generally has the superstars, the ones who are close to their 52-week high, or they are not that close, but they are keeping up and not declining at a rapid rate. And so what became clear to me, here is Walmart, Altria, is that I could literally stare at this one graph somewhere in the middle of the day, find the companies that are towards the far right of this 52-week range, or those, here's an example, a company where it used to be at the far right and it's now falling back at a rapid clip on one day and moving back at another day. That is the volatility on the right two-thirds of the range. If I can identify those companies earlier in the game, I may have something here. And as I started doing this analysis on these 10 companies per sector times 9 sectors, a couple of things jumped out at me. First is that the technology sector by nature has enormous volatility. This is nuts, 40%, 30% volatility, and yet they are all on the middle right side of where the range is. That means it is very rapidly moving on the right side of the index, which means they are pushing the envelope of take me, which is what Palantir did for 3 months before it got incorporated into the index. So then you have to sit there and say, I wonder what the correct way of analyzing would be. Here is real estate. Nothing really has a chance at displacing anybody else in the NASDAQ 100 or the S&P 500. If anything, these are the ones that may get booted out. At least that's what the data says. So I thought, gee, I wonder if I can understand more about the technology sector. I picked the 3 stocks, Riggedy Computing, which I did talk about in the previous episode, Qubit and QBTS, all of which moved on an average day 30% to the positive or 30% to the negative. Insane volatility. And as long as the net movement is to the right side, holding it for several days should push it closer to being part of the index. Here is the volatility over a period of 10 days. And this is not for the faint of heart. It goes anywhere from 60 to 220% in a 10-day period. What that tells me is, in theory, if I held the stock for 10 days, I should see a 60% movement up or down, hopefully not down. And if I see a 60% movement up or down, or 100% movement up or down, then I may be able to play a different game called house money. Let me explain what I did. So let's say about $1,000 worth of Riggedy or Qubits or QUBT. If I was so lucky that it went up by 50% and the new balance was $1,500, I'm just using simple examples, I could then sell my basis, which was $1,000, and leave the remaining 500 in the market. This 500 is house money, so to speak. Even if that went to zero, I already got my money out. But if that 500 went up or went down, I could be a little more relaxed about it and not worry about it too much. And so that is exactly what I ended up doing. I bought a bunch of Riggedy every day. The stock would go up. And the very first day it showed a blip to the other side. As long as I had made 40%, 50%, I would sell. So here are a whole bunch of buys. And the moment it blinked the other way, now you could argue, hey, it could blink the other way on many different days, but using periodicity, and I'm not arguing anybody else should do it, I'm sharing what I did. So this is from the 11th to the 18th. It's a 1-week period. It gained about 50-something%, and I dumped it. Here is Qubit going from 11 to 22 on a 3-day period. And so here is what I ended up doing. In my world, I started looking at how can I use volatility to my advantage, and I developed some patterns. As I started doing that, it also occurred to me, gee, I wonder if I can apply that on a broader scale, but not on catching daily variations, which is tiring. Because at the end of the day, the index rebalancing process is trying to catch companies whose revenues and profits are growing slower than their share price. In other words, companies whose share price still have room to grow. So I thought I could set up a filter to catch more of the riggidies and the qubits, except those where I don't have to wake up every day and stress out with these 30-40% movements. So here is what I did. I looked at the 3 stocks that freshly made it to the NASDAQ 100 to see what is true of them. Look at that. Revenues on Axon look like a straight line, every quarter posting very decent increases. Earnings per share is not a straight line. They have a little bit of annual periodicity. Cash flow is not a straight line. It appears to be revenue and share price. If revenue and share price are both going up, but if revenue is going up on a steeper incline, if revenue is going up faster than share price, it biases that stock to be part of the index. How about Palantir? Palantir revenues are also going up on a straight line. My humble opinion, a PE ratio of 395 is insane for Palantir, but you do you. But Palantir also shows revenues growing at a very steady clip and share price also increasing at the same time. MicroStrategy, as unpredictable as the company may be, does not show any difference in revenue. If anything, it's flat, but its share price keeps growing up. So I set up a very simple filter to catch more of these fish. Let me explain. Domestic companies, market cap more than 8 billion. It can belong to any index. The percent held by institutions has to be greater than 60. Revenue has to grow by 15% or more. The share price has to also have grown by 15% or more. Not a lot of debt, and I don't want to pay a lot on the PE ratio basis. This, in my humble opinion, is the thesis of how a stock makes it into an index during rebalancing. And when I then sorted it by PE ratio to pick the cheapest stock that didn't have revenue and where, that didn't have debt and where revenue was growing faster than share price, here is what I got. PE ratios going from 7 until 27, sorted in ascending order. Revenue growing from 24% on, except share prices sometimes grow faster than revenue, and sometimes the share price grows slower than revenue, so I'm looking for a disconnect. Here is an example. UTHR, United Therapeutics, revenue is growing at 25% over the last 12 months, but their share price is only growing at 17%. That's interesting. And their PE ratio is 15. MCore Group, revenues growing at 17%, share price growing at 20%. And finally, a Goliath, Meta Platforms, revenue growing at 23%, share price only growing at 18%. What that told me was where I should put my eggs in my basket. I did buy several equities when there was a big crash a couple of days ago, and so far things are going well. But my equities are organized in this simple 3 bucket areas. First is what I call house money. Yes, I played the roulette and I won. And so I sold my basis on several of these stocks, quantum computing, Rigetti, D-Wave. I just let the rest sit in there. So that's the proverbial $500 of the 1,000 that's still going up and down every day. In some cases growing by 60%, 70%, and it's free money the way I look at it. There is also another classification of companies where I started looking at companies whose share price today is less than the day before COVID first broke out. And there are 4 companies or 3 companies that come there. One is Target. I've talked about Target before. CVS Health has a lower price today than they did before COVID. And that's a very interesting fact for me. Moderna, and everybody knows about the Moderna vaccine and the wild ride up and down. My humble opinion, the company has a platform that can be applied in the future. We'll see what happens. So I did pick up some Moderna. So I have house money pre-COVID, and then the previous analysis that you saw where the share price is growing slower than revenue. I picked up the ones that qualified there. Last but not the least, we don't have the time in this episode to dive deeper. There is a company called Natera. Natera does a blood test to tell you information that today only a biopsy could tell you. It's insane. I got to talk to a couple of physicians about it. I was excited by what I heard. You have to do your own due diligence. Their revenue is also going up on a straight line, and they are entering new markets. So I'm hoping to get lucky on Natera. Well, that is me. I used to discuss how my portfolio looked at the very, very beginning. I'm doing it at the very end, so people who know what my portfolio looks like can tune out by this time. Barely a month and a half ago, I plunged 3% into equities. That was right after the election. I had made a whole bunch of positive trades during the election. I divested them, went into a really minuscule 1.4% allocation. I'm slowly adding back because I expect more volatility towards the end of the year. But my equity allocation is still a very small fraction. As far as sectors go, you can see that I'm starting to pick up healthcare. I'm starting to pick up industrials and even IT that I never had before. But my bread and butter is consumer staples. These are eggs and lemons and so on. And I do believe inflation is here to stay. Chairman Powell said as much. So I allocate most of my assets into fixed income. And within fixed income, you can see my stock basis is a tiny number. And most of mine are in treasuries. And within treasuries, it's short-term treasuries where I keep my money. And within what I mean by short-term is, 75% of my net worth I keep rolling on a 90-day basis. So if there is a crash, I can very quickly take advantage of it. That is me. You do you. There is no one way to succeed in the markets, and I'm here to learn from you just as much as I'm here to share what I learned. Thank you, and happy holidays to all of you.